Welcome everyone to our webinar on R&D tax incentives today. Are you leaving money on the table? Hopefully not, but if you are, we can help you identify, gosh, am I eligible for the R&D tax credit? What would that look like? How much is the R&D tax credit worth? So I have some amazing presenters with me today, and let's see if I can get the slides to advance. You'll see there's quite a few of us up at the top. Presenting with me today is Jesse Wutke. He is a partner in our Sacramento office, has a long history of doing R&D tax incentives. Another one, Lyle Henning. He's a senior manager in our Minneapolis office. Again, a wonderful career working in the R&D tax credit. And then, of course, me, also based out of Minneapolis. Partner with Eide Bailey and focused on R&D and ERC. But we're going to talk about R&D today. And as I mentioned earlier, there's a number of people you'll see up at the top. We have breakout rooms at the end of the session. And so you can hop into a software breakout or a manufacturing breakout or a general session, and you can actually talk to some of our wonderful folks, ask questions. I know they have some case studies to walk through, but again, some great content at the end of the session in those breakout rooms. All right, and with that, let's talk about the agenda today. So we'll give you an overview of the R&D tax credit. We'll talk about what are the qualified activities, what are you doing that could be identified as R&D. We'll talk about qualified expenses and the credit computation. Again, going back to okay, how much is this worth, Jim? And then finally, we'll talk about some recent developments, what's happening in Congress, what's happening in the court system, some other considerations you may have around the R&D tax credit, and then we'll hop into those breakout rooms. All right, so we'll get started here, right? And so let's talk about the R&D tax credit, or well, R&D tax incentives first, right? Because there are several incentives that I'll hop into in the next slide. But why do we even have this? Why is there an R&D tax credit? Why is there an R&D tax deduction? And really a couple of reasons. One, we want to promote innovation here in the US. We want companies to continue to push the envelope in what they're trying to do. If everybody was stagnant, we wouldn't have all the wonderful technology and innovations we have today. And so this is a little bit of a return on that investment. We also want to help US companies stay competitive. There are a lot of countries out there, Ireland comes to mind, that have wonderful R&D incentives. And you can offshore your R&D. You can do it overseas and hire talented people to do things and get great tax benefits. We need to have worthwhile tax benefits here to keep people and these jobs in the US. So again, it's really to help US companies remain competitive. We also have state incentives, and it's really along those same lines, right? We want to keep jobs in a specific state. We want to encourage companies to build R&D operations in a specific state. And R&D tax incentives aren't the end-all be-all, right? But they certainly make a difference when identifying, gosh, where do I want to hire people? Where do I want to develop software? Where do I want to manufacture something or have my engineering team? So that's why we have R&D tax incentives. Now let's talk about what they are, right? And the first thing we have is a deduction. And now an amortization of R&D costs. So in the US, give a bit of a history lesson here, right? R&D deductions go back to 1954 in that tax code. Basically, if you spend time doing research or experimental work, the costs associated with that R&D work could be currently deducted. That means you take it on your current tax return. It's a reduction of, or it's an expense against income. We do have a law change back in 2016, which we'll get into a little bit more later with the other considerations or recent developments. But basically, for a long time, we've always had the ability to capitalize and amortize those R&D costs, which means basically you capitalize them and deduct those costs over a 5 or 15-year period. Now that's going to be the standard unless we get another law change. So again, that current deduction, again, going back to 54, that was basically the first R&D tax incentive. In 1981, we have the R&D tax credit. So now it's a narrower definition, but basically for R&D costs, you get a credit, and that's a dollar for dollar reduction of your tax liability. So it's even better than a deduction. And then you also have state incentives, right? So the same deduction, most of the, the states couple on that, right? So you still get an R&D deduction. And then many states also have a credit, and we're actually seeing more states actually bring the credit back if they got rid of it for a while, or some states actually just add an R&D tax credit. So, and what's important there is, gosh, state incentives can be pretty significant. So that's a little bit of an introduction on R&D tax incentives. And I'm going to hand it over to Jesse Wutke to really kind of give you the bottom line. Or gosh, this is how it could impact you.
Thank you, Jim. So yeah, the R&D credit it's beneficial. There's a lot of money that can be spent on research and development, but we don't get every dollar we spend back in the form of a credit. A general rule of thumb that we use is a range of 5 to 8% would be the return. So if we're spending $1 million on R&D efforts, 5 to 8% could be $50,000 to $80,000 of R&D tax credit. So when we have our revenue, we have our deductions, we arrive at taxable income multiplied by a rate. That's our tax liability. The credit is going to slash that liability. So it's a dollar for dollar offset against the tax liability. As Jim mentioned, many states also offer R&D credits, and some of them are even more beneficial than the federal credit. So, and all that, what I mean by that, if it doesn't make sense already, if you have a federal credit that's $20,000, there's some states where it might be worth an additional 22, 25. So sometimes they're equal to, sometimes they can be slightly more, and some states certainly are quite a bit less than federal. So it just varies from one state to another, and how competitive they want to be. So that's it on the state side. We have the option for some startup companies to use the R&D tax credit against payroll taxes. So in most cases, the R&D tax credit is used against income tax. But for a startup where we're operating in losses, one really nice benefit for those that are eligible is to make an election to use those credits against payroll taxes instead, so that we can get a benefit right away. We're going to move on to qualified activities. Any company that develops a product should be eligible for an R&D tax credit. So whether that's a tangible widget or it's software, or you're developing a new process, a new technique, formula, an invention, the R&D tax credit is available for you. So generally, we're looking at everything listed here in this slide. So products, processes, software, techniques, formulas, inventions. And we'll get into this a little bit more in the next slide. All right, so if you are developing a product, a process, technique, formula, invention, you name it, okay? If you're a company that's developing anything, you're designing something or developing something, whether it's for yourself or it's for a customer, again, you should be thinking about R&D tax credits and claiming those as a benefit for you. And what it comes down to is the activity behind that effort needs to satisfy what we call a 4-part test. So each of the 4 parts has to be satisfied. So we'll kind of walk through these real quick, and and think about, your company, or if you're a professional that has clients in the space, think about, their activities and whether this would apply. So first, we have to have what's called a permitted purpose. And what that means is, what are we trying to do? What is your objective? What is the goal of this effort that you're taking on? And we're looking for you to be developing a new or an improved product, a process, technique, formula, invention, like in the previous slide. And it could be that you're improving an existing product or process or technique or software. So eliminating uncertainties at the beginning of our effort. Again, we need to have some technical uncertainty about our capability of achieving the objectives. What is the appropriate methodology or product design? Okay, so at the beginning, there have to be some unknowns. Okay, we can't just know the solution from the beginning. Third, there has to be a process of experimentation. Now, a process of experimentation can be trial and error. It can be the development of prototypes, doing some modeling and testing against those prototypes or those models. Some process, okay, some systematic process where we're trying to learn, overcome our uncertainties and learn and hopefully achieve the objectives and the permitted purpose. And then lastly, the activities we're talking about are those that rely upon the principles of hard sciences. Okay, so these are the biological sciences, computer science, engineering, etc. So we're not talking about, managerial sciences, the arts, or anything like that. These are technical challenges, and we're using, hard sciences to overcome those questions. Let's move to the next slide. Yeah. So activities that will typically qualify. Okay, so I mentioned earlier that we could have, new product design. So if we're trying to, develop software or a, tangible product, okay, a widget of some sort, we might not know how to achieve the objectives that we're looking for. For a physical product, we might need to develop some molds, some tooling, dies, fixtures, jigs, you name it. We don't know what materials would be best. What type of aluminum do we use, or steel, or some sort of carbon. And these are part of the processes of trying to figure out this new product. On the software side, what language do we use? We also have questions about, is it internal use software, or is this going to be something that we're going to make available to outside parties? These have a bearing on your R&D credit on the software side, and there's perhaps different levels of or thresholds of innovation that have to be met. But that's something that we can work with you on if you have internal use software. A lot of the activity that we're looking for is going to be the design aspects. So if you're developing a product, most of your R&D credit is going to come from pre-product, pre-production. So all of the design, the calculations, the proving out, all of the alternatives that you consider and measure against each other. So at the bottom of this slide here, it's really those engineered design efforts. We work with a lot of people who are developing, chemicals or food manufacturers, things like that. So a lot of this can be applicable to formulation. And again, you're going to have to try to figure out, you're going to design and you're going to develop, engineer, develop that formula to be able to make the product that's going to be sustainable. All right, and This next section is going to be, we're going to talk about some qualified expenses and credit computation. I'll turn this over to Lyle Henning.
Thanks, Jesse. Yeah, so getting into the kind of the calculation itself, there's three basic costs that we get to look at when we're analyzing what qualifies, after we get past the project qualification. Here's the expenses that we can qualify. And basically there are wages, supplies, and contract research costs. And I'll go through each one a little bit in detail. But wages, we're looking at those individuals who are doing the direct involvement of the R&D, who are the engineers, who are the designers doing the direct development. But then you can also have those who are doing direct supervision. So who is giving input to the team as to what they should be developing or what features do we want on this? When I talk about direct supervision, it's more kind of that functionality aspect, not necessarily, they're supervising from a budget standpoint. Again, budget is not a technical aspect, therefore it wouldn't qualify. But if they're giving direction on here's where we want the company to focus on, what's the new product, what's the new features, that type of supervision is what we're looking for. And then we can also have direct support people. And direct support typically are, if you're in a manufacturing situation, they would be potentially the manufacturing folks, those who are building the prototype or the first pilot model of this product. Until that uncertainty is proven out, their time building that prototype is potentially qualified. So what we do in that is we basically look at it at an individual level, who the employee is, what sort of percentage of time that they are spending in a given year on the qualified activities. And we can do that percentage based upon either time tracking or through some form of estimation with you. But we take that percentage of their W-2 box 1 wages to come up with a qualified wage amount. We total that up for the entire company. That is our wage amount, qualified wage. Supplies are materials that are used in the research. So, if you're in a laboratory situation, it would be chemicals and things that you're using, reactors, things of that nature that you're using as part of the testing, development. But in a manufacturing situation, it would be, raw materials that are going into that prototype or the pilot model. It could be materials that are going into a jig or fixture that we have uncertainty about, that gets scrapped or whatever. What I always tell people is if you have any failures as far as prototypes or anything like that hiding in a dark corner, bring them out, celebrate them a little bit, take advantage of them. Those materials, those activities are going to qualify. And then the third cost are contract research expenses. That is money that you're spending with an outside company to help you in whatever you're doing, whatever you're developing. So if you have an outside engineering firm that's helping you on the design, if you have an outside, machine shop helping you build that prototype or whatever, those costs can qualify. What we look at with contract research is always who's at economic risk, and that comes down to how are you paying them, and who has the rights and the risks to the research. But again, we get into that discussion as part of the analysis. The only downside with contract research is we do have to take a 35% haircut off whatever we identify as qualified. So if we have $100,000 worth of qualified research in a contract situation, we're only going to be able to take 65% of that, or $65,000, into our calculation. It's just part of the rules. It's what the IRS has defined for us. So, Jim, if you want to flip. So a little bit about the calculation from the federal perspective. There are two calculation methods. So first of all, the R&D tax credit is an incremental credit. So it is really based upon increasing R&D activities from year to year. You're going to get a better credit if you spend more money each subsequent year on R&D. That's not to say that you can't, or if you're flat on your R&D spend from year to year, that you're not going to get a credit, but you're going to get the biggest bang if your R&D increases each year. So on the federal side, there's two calculation methods. One is called the regular credit. One's called the alternative simplified credit. The regular credit has been around since this credit was introduced. It has a maximum net benefit of 7.9% of whatever the qualified research expenditures that we identify. The challenge with this one is it has what they call a base period. And the base period is defined in the tax code as being 1984 to 1988. If you were around in that time period, if you were not, they have what's called startup company rules. But basically what we're doing is we're analyzing what was your spend in those years as a ratio to your gross receipts in those years. And then that base percentage is multiplied times the current years or the current periods, 4 period years, gross receipts to come up with a hurdle amount. So as I said, 1984 to 1988, it's a long time ago. It can be challenging to get the records from that time period and so forth. So a few years back, they introduced what was called the alternative simplified credit. It does away with the base period calculation. And what it does now is it just looks at, also did away with the gross receipts question. What it does is it looks at what did you spend in the current year compared to what did you spend in the 3 prior years. So we're always, anytime you start an R&D credit, if you're doing ASC, you're going to be looking at not only what did you spend in the current year, but also what did you spend in the 3 prior years to build that base up. But alternative simplified, it's not as clean, percentage-wise, I can't estimate it as cleanly as a fixed fee, regular credit, but it does range in that 6 to 8% of QRE still. So when I talk about the payroll tax offset, Jim mentioned it at the beginning. This was something, again, that was added a few years back. It really benefits a startup company, as Jim said, who is in a net operating loss. Because they were in a net operating loss, they were doing tons of R&D, but the R&D tax credit was not necessarily enticing to them because they were paying for our services to calculate something that they're going to use down the road. With the payroll tax offset, if you are in the first 5 years of having gross receipts, and you have less than $5 million of gross receipts in the current year, you can use whatever we calculate as the R&D tax credit to offset your payroll taxes. And it just changed in this last month. It used to be a $250,000 cap. Now you can offset up to $500,000 of payroll taxes. So that was a recent change. I will tell you, there are still some payroll companies out there that are still struggling with this a little bit, but most of them have been doing it for a couple of years now. So they've gotten better. It just takes a little bit of monitoring with them to make sure that they are applying it to your payroll tax returns on a quarterly basis once it's calculated. So a little bit of case studies, kind of give you some examples here. One, we've got a software company it was this legal industry client that was developing software. They were developing a technology platform that allowed for custom tailored solutions for each client. And basically what they benefited out of that was, a $300,000 credit combined between federal and their state credits. But, legal industry is not typically one you would think of, but they have, any industry that is developing software for themselves is going to be a candidate. Manufacturer distribution of consumer products. Again, they were heavily into new product design and product enhancements. They had people in Utah, Texas, and Wisconsin. So we had the federal credit plus 3 states, and they had about $60,000 to $100,000 combined credit in each of the years that we did the analysis for. And then finally, a structural engineering firm. We did a 4-year study. They are basically a structural facade developer specializing in unique materials and energy efficiency. Again, federal credits of $111,000 across those 4 years. So it's a pretty good tax savings on those clients. And we have, those are just a couple of examples. We have, credits that range anywhere from, $5,000 to $10,000 all the way up to, over $1 million. So it all depends upon your fact pattern of what you're developing, what activities do you have, what sort of staffing do you have that qualifies.
Excellent. And Lyle, I guess a couple thoughts on this slide, right? The first one is this is an annuity, assuming you continue to spend on R&D, you can have 111,000 in federal and state tax credits every year.
Yep. Yeah, it's a great point. We do as the bottom one says, we did a 4-year study. That was our first year. We can always do, the current year plus typically 3 prior years. Those tax returns are still considered open by the IRS. But then once you do that, then every year we can come back in and help identify, okay, what were the qualified activities for the current year? What were those expenses for the current year? And come up with what is the new credit for the next year. And every year, as long as you're doing R&D activities and they're staying flat or they're increasing, you're going to be getting a credit each year. So
yeah, and leave it to me to pick the one example that is a 4-year study number versus the other two say, hey, yeah, each year, right? But to that point, it's an incremental credit. So we may see it go up and down over time, just based on how much you spend in a given year. Gosh, we had a huge prototype in 1 year, so your credit's up, but it may go down the next year because of, like you talked about earlier, Lyle, that rolling 3-year average.
Yep, excellent.
Excellent. Thank you. I appreciate that.
So I'm going to flip it back to Jim. He's already inserted himself a little bit, but flip it back to him for some recent developments and other considerations.
I joke, but I haven't talked in 15 minutes and I get antsy, right? So let's talk about tax reform, because this is a topic that is just near and dear to my heart. Each time I joke, it is the Accountant Employment Act, right? Because of all the fun tax provisions they put in there. And we're going to start with one that isn't exactly new, but it just didn't fall into place until 2022. So if you go back to 2016, we had the Tax Cut and Jobs Act as part of the Trump administration. So the TCJA came out, and basically R&D was kind of buried in there as a pay for. So I think, or hopefully you remember at the top of our webinar, I talked about R&D deductions, and everybody loves a current deduction. However, R&D, the current deduction piece was a victim in the TCJA in that they used it as a pay for to give other tax cuts and breaks, right? They want these things to be as revenue neutral as possible. But at the end of the day, they took away your deduction and they said, gosh, if it is domestic R&D, you have to capitalize that and amortize it over a 5-year period. And if you have foreign R&D, this has to be capitalized and it is amortized or expensed over a 15-year period. Now, keep in mind that these are technically your 174 costs. So there's kind of 2 tax codes in play here. 174 is pretty high level. These are your R&D costs. And then Section 41, that's your R&D expenses for the R&D tax credit. So that's really what Lyle talked about. So keep in mind, this is a big bucket of items. There are a lot of expenses that would get caught up in this capitalization and amortization that don't actually flow into the R&D tax credit. And how does that impact you, right? So this went into effect as of January 1, 2022. And that means for this year, you are capitalizing these expenses and amortizing them. So you're getting basically, less than 20% because it's a half year convention. When you think about depreciation rules and all the fun stuff, right? You're getting less than 20% of your deduction in this year. That means your tax bill might go up. So you may have to make larger estimated payments. Just something to think about. We'll have to see how this shakes out, right? This is largely unpopular. So we were hoping in the Inflation Reduction Act of 2022, this would get reversed. We also hoped it would happen with the CHIPS bill and all the other legislation that's come down. It was at one point part of Build Back Better, right? So unfortunately, this hasn't been changed yet. What our legislative affairs folks tell me is, gosh, Jim, our best chance of getting this flipped is basically December or January when they pass a tax extenders bill. So as you may know, there's lots of tax provisions and incentives that expire at the end of the year, and they generally get extended. You generally have kind of a lame duck Congress, right, that gets these done. If you're a publicly traded company, right, the big question is, okay, what happens if they pass this in January? On my financial statements, do I still have to show them as capitalized? If for at least the tax return, if we get the extender bill done and they would make it retroactive, then we're back to really no impact on your tax returns. It's as it was the last several years, right? If we don't get this change, well, yeah, tax bills are going to go up. And you could say, well, gosh, Jim, those are just ordinary and necessary expenses, right? And I'm going to currently deduct them. Well, the problem is if you label them as such, you're going to miss out on the R&D tax credit. You can't have your cake and eat it too. So that is the whipsaw there if you choose to currently deduct them. One quick note on software development. So this really follows on a revenue proc 2000-50 that basically said software development expenses are basically considered R&D, and they codified that. No escape for the R&D or for the software developers out there. So really, we're just waiting on Congress now to hopefully reverse this provision. I keep pushing the legislative affairs folks. Hey, I really need this done by the end of the year, and they're like, Jim, if we can get it done in January, we will take it, and it will be a win. So I guess we're probably in a holding pattern, at least until after the elections. So that is what you need to know on that one. I'll talk about a few court cases that have impacted us over the last several years. And I'm not going to do a deep dive here because one, you probably don't care, but two, you're more interested in, gosh, Jim, what's the fallout? And what is the IRS looking at, right? And so we'll start at the top with Seymour Milling. This came out in April of 2019. They had an R&D tax credit, and it was unfortunately disallowed by the IRS. And basically, the focus was on the process of experimentation. So when Jesse walked through that 4-part test, right? Your permitted purpose, your technical uncertainties, the process of experimentation, and relying on a hard science, right? They really focused on the process of experimentation here. They said they failed to show adequate documentation of their process of experimentation. And they really pushed it as all they were doing was trial and error, and they didn't follow a scientific process. Again, each client is unique, each fact pattern is unique. The thing I guess I take away is adequate documentation. They failed to provide it. And who maybe the client had it, they just, again, it didn't make it to the court. So either way, I think those in this field kind of feel like this one was a fail on the legal firm that represented Seymour Milling. But regardless, we have to live with this decision right now. which gets us to another area that that the IRS looks at. And I don't know if it's Tangle or Tangel, but this one was also disallowed by the IRS, and again, a different area, right? So they failed to show that they had substantial rights in the development. When you're developing something, you have to have substantial rights in what you develop, and you have to be at risk. And so I know we probably didn't go down that rabbit hole in this discussion, but in this case, Tangle, failed to show that they had substantial rights in the development, and the contracts were just kind of weak. So again, something you need to be on the watch for, and why I always recommend you have a competent provider do this work for you. In Harper, this one was actually a taxpayer win. And it kind of dovetails into a slide I have a little bit later. But in this case, the IRS tried to require facts sufficient to highlight the exact basis for the R&D claim. So they actually filed some amended returns, and basically the IRS was pushing them, well, you did not provide exact and sufficient documentation to substantiate your claim on an amended return. Now, again, the taxpayer won because this was, just unreasonable, but it did lead to the specificity requirement, which I'll get into in a couple slides. Little Sandy Coal, this one was also a taxpayer loss. The IRS disallowed it. We do know it will be appealed. This one also goes back to process of experimentation, and really the taxpayer in this case failed to highlight adequate documentation to show that they were undertaking a process of experimentation. And then, I'll get into Leon Max here too, just because it kind of follows along those same lines. You have a clothing apparel manufacturer, and they failed to adequately document their technical uncertainties and their process of experimentation. They actually highlighted Cymer milling, and the scientific method is one of the reasons that they disallowed it. So you'll see a trend here, right? You need to have great documentation in place to substantiate your credit if you're audited. And again, that's why we recommend using a provider to help you through this process, because the IRS is certainly looking at areas of vulnerability, and each client is unique in their documentation process, but we're seeing more and more pressure on, having contemporaneous documentation to highlight your technical uncertainties in the process of experimentation. All right, you guys are probably ready to move on from court cases, but let me highlight another recent development. So most of you are probably aware of the employee retention credit, which you could claim for 2020 and 3/4 of 21, and really 3/4 of 2020. But in 2021, you can't take the same wages for R&D and ERC. So again, it makes sense to have a provider work with you. The ERC is a much higher credit rate, a 70% credit rate in 21, over up to $10,000 in wages per quarter, right? So my team is fantastic at identifying or maximizing both provisions, because again, you want to maximize your ERC first, and then you can maximize your your R&D around that. But we're pretty darn efficient at how do we make this work? How do we model out those costs so you can maximize both provisions? Because last thing you want to do is miss out on credit. So I teased this a little bit earlier. We had a chief counsel memorandum come out in November of 21, and we call it the specificity requirement. Try saying that 3 times fast. But basically what we have is we have increased documentation requirements for R&D credit claims. What are claims? So right now, that definition is amended returns. If you file an R&D tax credit on an originally filed return, you don't have to provide this additional documentation. This went into effect on January 10th of 2022. So if you, anytime after that, you basically need to include a host of documentation to amend your return to claim an R&D tax credit for refund. So what does that documentation look like? Well, it's basically an R&D study. So you need to highlight the individuals who are performing the R&D, what they're doing, their associated wages. You need to identify your supplies, all your projects. It's fairly comprehensive. And again, you go back to the case the IRS lost, where they're really trying to, they want additional detail, right? And is this a good thing? Yeah, actually, is it a pain in the tail? Sure, but at the end of the day, we know there are some people that are claiming the R&D that don't really qualify for the credit, and the government's just trying to limit that behavior, right? So the way we feel is, hey, you know what? If you're doing qualified R&D, let's document it and let's attach it to the return. You know what? It should hopefully speed up the process if you're ever audited, which we know can take years. Some of that due to COVID, but the reality is they were taking a long time anyway. You know, in this bill that passed, the Inflation Reduction Bill, the IRS is going to hire some 80,000 additional agents. I don't know where they're going to find them, but the reality is we can only expect more scrutiny. You know, the other question that's out there that I've been asked is, hey, Jim, is this ever going to be required on an originally filed tax return? And I think the answer is yes. The reality is the IRS's software systems are antiquated. This is one way to help them target unscrupulous providers and really help those who are deserving of the R&D tax credit instead of just, you know, the random audits that they're doing. So that is the specificity requirement. Again, all amended returns going forward here for R&D credit claim for refund will need to include this documentation. All right. Speaking of documentation, you know, you heard me in the court cases talk about, gosh, they failed to show adequate documentation. This is why it's in the courts. There's no specific record keeping requirement, and the IRS is often really aggressive on the documentation substantiation. You know, we do our best to make sure that you have adequate documentation. I get plenty of taxpayers say, gosh, Jim, I don't know if we have enough. And the reality is we can work with a lot of stuff. We work within your system to identify, okay, how'd you meet the 4-part test, right? What documents do you have that, you know, highlight what you were trying to do, your technical uncertainties. Those might be emails between engineers or software developers, right? Again, there's no specific document out there. I wouldn't fret over this on a daily basis, right? But you do want to make sure that you have documentation in place that shows how you meet the 4-part test, as well as, you know, the expenses incurred, right? You know, hey, these were truly tied to this project. It wasn't just, you know, some random expense. The other thing that the IRS has been after for quite a while is that we need to show nexus between the qualified activities and the qualified costs. So really what the IRS is trying to do, and what we've been doing for a long time now, is almost capture your costs on a project by project basis. Yeah, there's some analysis. There's a little bit of swag that goes into those because it's not perfect. You know, even companies with time tracking, right? I tell them that it's not like it's based on 174 and 41 in R&D activities, right? They're just tracking their time to specific jobs. Not every part of that job is going to qualify for the R&D tax credit. So again, you're really working with a provider to help you break out those costs on a project by project basis. We can do stat sampling, and that's something that we do to help ease that process, especially if you have, you know, 500 projects in a year, right? So there are ways that the IRS has specific protocols for stat sampling, but basically ways we can help you meet those requirements and effectively document your R&D activities. All right, so let's talk briefly about our approach, right? Because you're saying, okay, gosh, Jim, it sounds like there's a lot of work involved in an R&D tax credit study. especially if we've never taken one before. Lyle's telling me that I've got 4 years of detail I need to provide under the alternative simplified credit, and Jesse's providing all these qualifications. Gosh, how does that all come together, right? So our approach is consistent with a lot of others in the industry. Before we even get too deep in the details, we're going to have a feasibility call with you, really understand your R&D activities, understand where there may be tripping points, right? So if you're a contract manufacturer and you have no rights to anything, we would identify that in that initial feasibility call, right? And you're not going to qualify for R&D. We also give you, you know what, we think there's a reasonable credit here, right? We're not going to go into a phase one scoping if we think, gosh, you know what, there's $800 in R&D tax credit. How does that benefit anybody? The other thing that happens in feasibility is we at least get a picture of utilization of the credits, right? It's one thing to have an R&D tax credit. It's another thing to actually use it. It's not refundable. You need to have tax liability. So at least in that initial call, we're understanding, hey, can you use the credit? And maybe not in the current year, maybe it's just a rough year, right? But hey, we're this next year, man, we are churning and burning, and we're going to have huge tax liability, right? So let's go ahead and get it, on an originally filed return. So there's those considerations. Once we get past feasibility, we do a phase one. Phase one is a scoping project. So we actually get wage detail, supply detail, contract research detail. We have calls with your development team, really understand what the benefit of the credit could be and over that entire period of time, right? So this is a lot of data gathering on our end, a lot of crunching numbers. And we present to you at the end of that, hey, this is what the credit looks like over your open tax years. And maybe, you know what, overall 2021 it's a $50,000 credit, right? But 2018 was just, we didn't have a bunch of developers, or we started hiring in 2019, right? And you know what, that one's only going to be $3,000. Do you really want to amend and chase that $3,000 knowing you have specificity requirement and other things, right? So at the end of that, you have a lot of information and you're armed with, okay, what do I want to chase? And so then phase two is, okay, what do you want to chase, right? We will get you a fee commensurate with the amount of work necessary to do the detailed analysis, documentation, perfect those credits, to again, help you file those credits. And those may include amended return fees. If our team does it, we would work with your tax provider on those to make sure we get the right fee for those. But again, that would be the phase two. Our costs or our fee is a fixed fee. We don't do a contingent basis. So again, you know what the cost is going into it. We do annual refresh studies for companies that are claiming the credit. In most cases, it's really to help them maximize their credit, right? Because if left to their own devices, they may just roll everything forward, and that's maybe not the wrong answer, or maybe that's the right answer, maybe it's not. The reality is fact patterns change every year. We have new case law. You really want an expert coming in and doing that study for you. And again, the last thing is, I think I mentioned this already, we have a flexible approach that's tailored to each company's needs regarding the scope we do, right? We're going to have to do more work if it's $1 million credit versus a $20,000 credit, right? So just keep that in mind. All right. So that is certainly our approach. Like I said, the hard stuff is really in phase two. On your end, really phase one, there's some calls and a lot of information you need to provide us, but there's a lot more work that goes on in phase two.